Welcome, and good evening, and wherever you are, good afternoon, good morning, Jerome, to another of the Learn, Grow, Invest meetings. This one today is another very special one again, with a lot of gems to unpack, a lot of knowledge to impart. We're going to be basically doing a financial review of one of the companies on the Jamaica Stock Exchange. So, to everyone here, we thank you very much for being with us and looking to spend your afternoon with us. And as you normally know, we normally like to open our meetings with a word of prayer to just put everything in the right hands. So we're gonna do that quickly. Then we will get to further introductions. All right. So, Heavenly Father, we thank you again once for bringing us all safely today. We thank you for everyone that has joined. We hope that the information that will be discussed and be imparted will reach minds and help those who are looking to make the right decisions in terms of their investing methodology based on what we will discuss today. Will be able to allow them to do so soundly, efficiently, and that they will be able to realize down the line, in whatever time frame they have, immense gains. We thank you for everything that you've provided and the protection that you provided for each of us, our families, etc. And we ask for protection going forward. We commend this session in your hands. In your precious name we pray. Amen. All right. So, as usual, the housekeeping matters, but the first big one, as we normally do, is just to let you know once again that this is definitely not financial advice. We are not financial advisors. So, please speak with your licensed financial advisor to ensure that everything that will be discussed today actually has its merit, right? Of course, we would like as well, based on our community, that we get to much more persons. So we always ask that you like, share, and subscribe to our feed, our channel on YouTube. You can find us on Twitter, on Instagram at Learn Grow Invest, and thereafter, so we can get to more persons so that they can obtain this knowledge the same way. So with that, I move into our main segment of what we're here to do this afternoon. We're doing a financial review, and this person needs no introduction. He's been here before. You know him from multiple reviews that we've done in terms of our stocks to watch as well too. You know, trusted compatriot, Andre Thompson, top level analyst as far as I'm concerned with how we do our reviews today, and today promises to be a good one. Yeah, Andre, welcome.
Greetings, GK, greetings, Learn, Grow, Invest community. Glad to be presenting tonight again. Looking forward to a productive session and productive discussion.
Yeah.
So, all right. So, I know you guys ran the poll on Twitter, and the company most voted for that we review their most recent earnings was Wisynco Group Limited, the one that was victorious. Definitely a great company. It listed around the latter part of 2017, if I recall. But they have brands that many of us consume, brands that they manufacture, brands that they distribute, and things like that. So definitely a great Jamaican company operating in the manufacturing and distribution space.
Indeed.
So we all know. So let's look at the recently released the earnings for the 9 months ended March 2021. So we can go ahead and pull it from the stock exchange. I have it pulled already here. Share my screen. Say, assuming we've all known how to find it on the stock exchange website, I can probably just run through really quick. So I normally bookmark the daily market code sheet. So I just click that tab, I scroll for the ticker on the JSE website, Jam Stock Exchange with Wisynco Group, and I go to quarterly financials, and then there it is. This was posted on the 6th of May. And then we'll go ahead and open the file. So for starters, looking at the financial statements for the third quarter, I normally start off by looking at the directors and the management commentary preluding the financial statements, and it kind of gives you some insight, from a management perspective, how the company performed. They explain certain line items, things like that. So it's really educational, where they break down and they let you know like how the company has been operating. So to begin, they said the revenues for the quarter was a decrease of 6% below the 8.1 billion registered for the corresponding March 2021 quarter.
Hold on, Andrew, just 1 second. Make it a bit bigger. Just zoom in.
I need to zoom in.
Oh. Yeah, you do. Are we good? No. Yep, that's good. That's good.
That's good. All right. Yeah. So looking at this first paragraph right here, they basically, they got to the meat of the matter. Revenues decreased by 6%, and basically, according to the management, that was attributable to the surge in COVID cases during January and February, and the resulting government of Jamaica implemented curfews that would have resulted in business activities being slower than anticipated. So with respect to outlook going forward where revenue is concerned, they go on to further state that vaccinations have continued in earnest, especially in the USA and the UK. And given that Wisynco operates heavily in the hotel and tourism sector, USA, when it comes to tourism, the USA and UK are companies that we see most of the tourists they visit from the USA, especially. They're right above us. So they speak about the vaccinations that have been happening in the US and the UK, and they're seeing strong signs indicating of a positive bounce back in the tourism industry and an increase in the number of visitors expected to visit Jamaica. They give further and give commentary about production. So right here they state that basically the expansion of the production facilities over the years has resulting in them being able to resume production of bigger back in the Jamaican market. In Jamaica, local production, this is jobs that will be coming back to Jamaica. They said in the past, they licensed the production of bigger in the UK, and they're now proud to announce that the production has come back to Jamaica, and they look forward to continue to grow in the UK and all other export markets. They go further on to state that exports were up 50% in Q3 and 28% year to date. So that's double-digit growth in exports, So we're talking about hard currency that they would be earning. When you look at the statement, at least at first glance, I didn't find a breakout of the segments or the business that the company does locally and the exports that they do. But when I looked at the 2020 March financial statements, you will see the segment in reporting details where that is concerned. And if you look further, I think exports account for about 2% thereabout of the company's overall revenue. So this is the 2020 financial statement. So this is just to digress a bit from the quarterly report to the 2020. I just wanted to show how I was able to find the numbers that the company does with respect to exports. So on the income statement of the 2020 results, revenue, they give details on revenue at note 5. So I'll go ahead and scroll to note 5. I think that's where I found it.
And zoom in on that one as well. Yeah, there we go.
Yeah. Note 5. So note 5 right here. So see the break or the disaggregated revenue. So exports for the 2020 financial year amounted to 445 million, and this is compared to local business in Jamaica, which is 31.1 billion. So it's a drop in the well in terms of the company's overall revenues, but it's definitely a great outlook that double-digit growth for the revenue for exports year to date, and they're expecting this to increase once production of bigger is back in Jamaica, and then they continue to do that.
Yeah.
So further to go on further, the gross profit margin improved from 34% over 32% in the prior year, and they said this was mainly due to better cost efficiencies, which include co-generation activities. I think a while back they announced, where energy production is concerned, a mixture of heat and don't remember the specifics of it, but I know that they assumed that they were expected to, save about $1 million annually. Let me see if I can find that article. Normally,
Based on that, did they do a plant? Was it a plant that they did for their?
Yeah, they did a plant
for their energy generation.
Yeah, so
right,
LNG. Yeah, LNG plant investment, and let me see, I think I have another link here. Wisynco. This was an article, a Gleaner article, dated December 2019. They plan to cut the energy bill by $1 million with that new LNG plant. So one can assumedly say that the cost efficiencies that they experienced for the recent quarter would have been as a result of the new LNG plant, which would have resulted in the company's gross profit margin improving to 34 over 32. So they go on to speak about now the SDNA expenses. So it was a 9.3% decrease for the quarter to 1.9 billion from 2.1 billion for the corresponding quarter of the 2020 financial year. The company's expense ratio, the expense to sales ratio for the quarter was 24.7, which was slightly higher than expected due to lower revenues achieved. So as the name suggests, expense to sales, it's basically a ratio to assess the company's efficiency, where fixed expenses or the company's operating expenses is compared to overall sales generation. So basically, that ratio trended higher. Ideally, you want a lower ratio because this is more favorable. It suggests that revenues are much smaller compared to, expenses are much smaller compared to revenues. So they achieved a less favorable 24.7% ratio, mainly because of lower revenues. But however, on a year-to-date basis, the expense to sales ratio was 23.7% compared to 25% in the prior year, and they attribute that to the management team, their cost efficiencies amidst the downfall in revenue led by the onslaught of the pandemic. So with respect to the balance sheet, the company's balance sheet remains strong with a favorable current ratio and very good return on equity and return on asset ratios. We continue our review of investments for expansion and for cost-effective technologies to improve our cost of operations. The team goes on to recognize the passing of a valued team member during the course of the quarter, past chairman, Mr. Joseph Mahfood. We send, like the management team here, I send my condolences to the family and thereabout. So that's basically a synopsis of the company's, the management team's review of the financial statement. So let's go on to look at the numbers now. So I said the revenue, the profit and loss statement is first here on the list. So they basically have a breakout of the quarter ended the 31st of March 2021 compared to the same period in 2020. And then on a 9-month basis or 3 quarters, they show how the company has been performing year to their financial year, which ends in June. So right here we see revenue for the quarter. Revenue declined from 8.1 million to 7.6 million. Likewise, gross profit kind of fell off marginally, but I'm going to show an Excel. Normally, once companies that I follow, companies that I'm invested in, like I like to follow up with the earnings. I like to populate the earnings into a spreadsheet. that allows me to best keep track of the company's performance. I'll update the spreadsheet as time goes by, and it allows me to make investment decisions, things like that. So basically, after we've kind of run through the statements, I'll share with you the spreadsheet that I work with that includes these key line items from the income statement, the cash flow statement, and the balance sheet, as well as key financial ratios and statistics that are computed using these information. So so revenues fell off, gross profit remained largely flat. Expenses, right here we see where they were able to contain expenses. Expenses fell from 1.7 billion to 1.5 billion, and administrative expenses moved from 355 million to 339 million. So that's how the company was able to achieve an improved operating profit, which moved from 549 million last year to 733. So that's good. Despite the fall off in revenue, it shows that the company's primary focus was on cost efficiencies, because at the end of the day, if we're in the pandemic, a lot of people are afraid to travel, so that is going to adversely impact the hotels with that Wisynco would supply with their brands. So that's going to result in reduced sales for them. And then we don't really have schools, so that's a fall off in revenue from key distribution channels for Wisynco. So the best thing to do is to basically minimize your losses and try to contain the expenses. You can't really, you basically kind of have to, you're in wait and see more to say once vaccinations continue to roll out, and revenue is likely to improve. But what you can control in the meantime is your expenses. So I think they did a great job where that is concerned. The finance costs, they even curtailed their finance costs. It fell from 41 million to 30 million for the quarter. And as a result, PBT, profit before taxation, improved. And the company was basically able to enjoy an overall improvement in their profitability for the quarter. So mind you, this is just for the quarter, from the end of December to the end of March. So year to date, which would have begun around June 2020 to March 2020. That's what the 9 months ended information here tells us right here. So on a 9-month basis, revenues fell from 25.2 billion to 23.6 billion. The company was able to control their direct costs. However, this wasn't able to fully offset, they weren't able to prevent gross profit from declining from 8.8 billion to 8.1 billion. Again, the cost efficiencies with respect to operating expenses that they displayed for the March 2021 quarter is further seen year to date. Selling distribution expenses fell from 5.2 billion to 4.6 billion. So they were able to reduce the expenses, whether it would be by less promotional activities, or I don't know how they did it, but they managed to do it. So kudos to the management team. Operating profit improved from 2.5 billion to 2.6 billion. It's largely flat, but they reported a marginal increase, so that's great for them. But however, when you boil down to the net profit figure, overall they're down by about a little bit over 100 million. And when we look at this, the main reason for the downfall in profit is the downfall in revenue. So the next statement that we have right here is the balance sheet. And this is an important statement. It shows the company's financial position at a certain point in time. The value of the assets relative to their liabilities and the resulting shareholders' equity. So that your total assets basically consist of your non-current assets and your current assets. Your current assets, which are your less liquid assets, such as your property and plant and equipment, loans, receivables, investment securities, dependent on tenant, things like that, investment in associate. So right here we see where the value of property, plant, and the company's fixed assets fell off marginally. So this could have resulted for a number of reasons. It could be marked down in property value, or they disposed of fixed assets. The statement of cash flows can give you a bit of further insight as to why this figure declined. When we look at investment securities, they've improved on their investment, their investing activities. So this moved from 270 million to 541 million. This could probably consist of things such as money market instruments, fixed income, your bonds, your corporate notes. They could hold equity securities thereabout. That's basically what this line item captures for the company. Loans could be loans distributed to whichever related parties, things like that, if it's classified as that. Sometimes you might have disburse loans across the Wisynco group. Sometimes you might say due from related party, or it could just be consolidated under loans receivables. So your current assets now, so these are your more liquid assets. So this represents the company's inventories. The receivables, money is due to them, money due from the parent company, the more liquid investment securities. So this line item would most likely reflect short tenured corporate notes and bonds, your money market securities. It's normally for assets that are due within a year. And then the most liquid assets, the cash and short-term deposits. So Wisynco is very, from looking at the balance sheet, you can see where the most of the company's assets is actually liquid assets. It's things that can be readily disposed of. So at a glance, what this suggests to me is that the company is able to cover short-term obligations. Should they be challenged with respect to operating as a going concern, at a glance, this 12.5 billion could readily cover the company's current assets. So basically, short-term assets can cover its short-term liabilities, and that's why we have a net current asset figure right here of 8 billion. So to further look into the current assets, receivables, inventory. So we see where inventories move from 3.1 billion to 2.8 billion. So what this suggests is that items have gone off of the shelf. So that's good. It shows that sales is continuing. Receivables declined from 3.1 billion to 2.6 billion. So this suggests that Wisynco has been efficient in collecting monies due to them from their debtors, due to them from people that order things and promise to pay payment at a later date thereabout. Due from parent company, well, this line items is largely minuscule, 130,000. It represents any monies owed to the company's parent, owed to Wisynco from the parent company. And then investment securities, the short-term assets that I would have mentioned earlier. So under the current asset, one of the key line items that you want to look for is the company's cash position. This allows you to further assess the company's liquidity position through ratios such as your cash ratio, your quick ratio, your current ratio, things like that. So the bulk of a large amount of the company's assets is actually held in cash. So investors like to see this because cash is the most liquid asset. That's our main medium of trade. So cash moved from 4.3 billion to 6.9 billion. And when we look at the statement of cash flows, that will basically disaggregate the movement in activities through the company's operating activities, investing activities, and financing activities. Current liabilities, which represents short-term debt now, we look at the company's payables, meaning money is owed from the company to money is owed to the company's creditors with respect to trade and things that they used in order to produce their goods. Right here we see where the company's payables declined from 3.6 billion to 2.9 billion. So what they've done, they've actually paid out money. They've paid out some of the monies that they've owed to their creditors. I always say creditors in this case, we don't mean in terms of loans that bear interest, just trade payables. So short-term borrowings now, which represents the company's or a part of the company's debt stock. This line item is assumedly most likely, interest-bearing short-term debt. So line items like these affect the finance cost line item that you would have seen on the company's income statement. Ideally, once the company's overall borrowings goes up, you normally see an increase in the company's finance costs. It's all dependent on on how efficiently the company is able to negotiate interest rates and things like that. But the rule of thumb is once the company's borrowings goes up, the debt servicing or the finance cost that the company incurs will also likewise increase. Lease liability, this represents lease. So it's in essence, I normally add this under the company's overall debt stock. It's lease payments that the company would pay for leases on lands, whatever office spaces they lease and things like that. And then we have taxation payable, money is owed to the government. So looking at the equity base of the company, or before we get to that, the non-current liabilities, this represents the more long-term debt. So lease liabilities, the estimation of the lease cost due in excess of a year's time. Same for borrowings, borrowings that essentially are due in excess of a year's time. So the company's borrowings actually declined from 1.8 billion to 1.4 billion. And at a glance, looking at the short-term borrowings, the lease liability, long-term borrowings under non-current liabilities, and the long-term lease liabilities, this kind of suggests to me at a glance, it suggests that the company's debt stock is relatively small compared to its asset base as well as its equity base. And we can further assess this once we plug these numbers into an Excel spreadsheet.
Right.
Looking at the capital base now, the company's overall shareholders' equity or the book value increased from 12.8 billion to 14.9 billion. So this is like an increase of 2 billion. And right here, at a glance, we can see that this was mainly attributable to an increase in retained earnings. And, this is expected given that the company is profitable. While net profit would have fallen when compared to the comparative period in 2020, the company is still profitable, and then those profits are normally added to the company's balance sheets and results in an increase in the company's retained earnings. So this is the group statement of changes in equities. It captures the movement in how the net profit affects the company's shareholders' equities, as well as other things such as dividend payments, gains on investments with respect to the company's reserves, the other reserves and things like that. This line item also basically captures any changes in shares, the issuances of shares. You're able to see that, and the cash flow statement, which should be the next step part of the overall financial statement, also shows how the movement of cash with respect to the company's operations.
Yeah.
So on a 9-month basis, basically to find out the movement of cash, first you have the net profit from operations, and then what you do, you add back the items, you add back or you subtract line items that are not affecting cash. So this what basically happens here is like things that are accrued or accounted for from an accounting standpoint, they're added back to the company's cash position. So depreciation is normally a charge for a write down in assets, as assets depreciate in value. So this show the company pays a lot in or incurs high depreciation. But for the 2021 year-to-date period, 9 months ending March, depreciation fell to 782 million from 831 million. So this is normally, I mean, earlier when we looked at the company's balance sheet, we saw where property, plant, and equipment declined from 7.2 to 6.7 billion. So that kind of suggests why depreciation fell off from that figure. Let me see something right here. Yeah, so that figure normally moves in the same direction. Depreciation tends to move in the same direction as the company's fixed assets. Fixed assets written off. There were no fixed assets written off for the March 2021 quarter, year-to-date period, sorry, compared to 115 million for the same period in 2020. Gain or loss of property, plant, and equipment, any resulting gain or loss with respect to the selling price of the fixed assets relative to the market price, things like that, are all added back to the company's cash position, dividend income. So what happens is that the first section of the company's cash flow statement is the cash provided by the operating activities. So this is an important part of the financial statements that I personally like to assess, because it allows me to assess the company's overall cash generating capacity. As an investor, it's important to know that at the end of the day, cash is king. So if you have an asset that is actively generating hard cash, that's definitely a plus, because it shows that the company is liquid, or at least has the ability to generate cash to service its debt. So normally, when companies generate high cash, they tend to be liquid, and they tend to be very solvent and things like that. So the company's
and they rally storms really well.
Come again?
And they rally storms really well.
Yes, because they have a pile of cash as a buffer,
Yep.
to withstand shocks such as the ones we would have seen from the pandemic. So right here, Wisynco has been able to consistently produce positive cash from operating activities. It was, one could say, marginal, relative to the overall cash that the company generates, but we've seen an increase of this is about 50 million, sorry. Cash moved from 3.2 billion to 3.2 billion, almost 3.3 billion. We see the exact numbers right here with respect to the movement in the company's cash generated from operating activities. Now, looking at the cash from the investing activities. So the company has cash on its books already, and the company is also generating cash from operating activities. So let's see how the company pumps that cash back into the business that will allow the business to grow, as well as overall investment activities. So this line item, the purchase of property, plant, and equipment, this is an important line item because it tells us how serious the company's management team is with respect to growing the business in terms of pumping capital expenditure, in terms of the company's capital expenditure, because that shows that the company is aggressive. It is aggressive in putting money back into the business and increasing, whether through expansion efforts, purchasing machinery to increase its operating efficiencies, setting up different branches, things like that. The capex is a very important line item. Purchase of intangible assets, intangible assets such as your trademarks and your licenses, things like that. Purchase of investments. So, as we saw earlier from the income statement where, the balance sheet where investment securities increase. This is where we see the movement in the company in the purchase of investments. Year to year. Come again?
They nearly doubled it.
Yeah, so they definitely pump more monies into investments. With respect to equities now is a good time to invest in equities. So maybe the management team saw a need for that, or maybe the company wanted to further diversify its earnings. So the generating cash from manufacturing has fallen off a little bit. So they could have opted to decide to use cash to pump into investing which would generate additional non-core income or other income. So strategic plays, that could be the reason why purchaser investments moved from 252 million to 463 million. Net proceeds. So by the way, when I don't know if I said this earlier, but when we see a bracket here, that means a cash outflow. So this suggests that the cash outflow, there was a cash outflow purchase. And then when we look at the net proceeds, this means cash received. So net proceeds from deposits held over 90 days. So this is monies that was returned to them. Proceeds on disposal of fixed assets, monies received from the sale of those fixed assets. 1.4 million last year relative to 973,000 for the current period. Proceeds from the sale of investments that they would have sold. They could have realized gains on these investments, could have realized losses, but that's the overall what they received from the proceeds from the sales of investments. And then this is interest received, dividends received, and interest received. All right, so looking at the financing activities now, meaning how the company pays out
Debt.
funds. It pays out not only the debt, but same to shareholders. So interest paid, this could be been a debt servicing cost on the company's loan book. This decreased from 135 million to 114 million. Proceeds from long-term loan. The company took out a $500 million loan during the current year-to-date period compared to none needed for last year. I mean, this is expected. Companies want to kind of manage the burn rate, how fast they burn cash. They want to have more cash as a buffer to seize opportunities as they arise. They need cash to stay liquid. So the company took out $500 million in debt, new finance lease commitment, long-term loans repaid. So they took out $500 million in debt, and they also paid down $496 million in debt. These long-term loans could have been due for maturity, or the company could have opted to refinance older, more expensive debt with cheaper debt, given that we're in a currently low interest rate environment. So there could be a variety of reasons for the movement in cash. The management commentary can give you so much and no more, but one thing I like, as an investor in the company or as a financial analyst, feel free to call the company's finance team to get insight, with respect to the company's financial statement, because this is public information. So you have the right, as a shareholder, you have the right to call and ask a simple question or shoot an email to them. I've done it before. It's allowed me to get information that was not in the financial statement, so it's definitely a useful strategy to further analyze a company.
Simon was saying actually it seems that from eyeballing the financials here, management is not friendly with debt, not very friendly with it. I like that still, to be very honest. I mean, I think that serves a purpose, but it must be used wisely. So,
it definitely seems like they're not really friendly with debt. And I mean, a lot of people, you can leverage loans from your banking partners and things like that, aggressively grow your business, but you also want to bear in mind that you incur finance costs. So I mean, if you're able to expand your business using your equity base or capital that the company has, the cash that the company has, then that's a great strategy.
Yeah.
You can also use debt, but at a glance, Wisynco is definitely one. Their strategic decision is to keep debt at a low, and they're able to overall enjoy being a very liquid, a very solvent company, and lower finance costs. Dividends paid. So this represents dividends paid out to shareholders. So this has largely been flat period over period, and one can say this is warranted because we're in some uncertain times. The company probably wants to kind of keep as much cash as possible, or to retain as much cash as possible. Ideally, from an investor standpoint, investors like to see where dividends increase period over period and year over year. But as I said, this goes without saying, trying times make sense to keep cash. I mean, some companies weren't allowed to even pay dividends in your top. So it's good that Wisynco was able to maintain their dividends that they pay out to shareholders. The effects of the changes in foreign exchange rates, companies can either enjoy or be adversely impacted from the changes in FX rates, basically dependent on the currency that the company reports its earnings in, as well as the cash, the currency that the company actually generates its revenues from. So things like that kind of affect the company's overall cash position and the short-term investments and cash and equivalents and all of that. So overall, at the very end, Wisynco saw its cash position move from 3.6 billion to 6.6 billion. So this is an increase of about 3 billion, as we see right here. Increase in cash and cash equivalents, 3 billion. So I mean, this is great from a cash flow standpoint. The cash flow, very important statement. The company is liquid, generating cash from operating activities. So the cash flow statement looks good. Further on, we have the notes to the financial statement. So when you're looking at the financial statements like the balance sheet, you have note. If you want to get further details with respect to a line item, you can look right here. So for example, one can say, okay, because the company has an associate, it's invested in an associate company. I wonder who that is. Right here, I can see I get further details at note 5. So scroll to note 5. And then we see here the company owns 30% of the share capital in JP Snacks, which is the manufacturer of St. Mary's chips. So things like that. That's how the notes to the financial statement allows us to further dissect and analyze the company's financial statement. So, our investor could be glad that they've got an exposure to St. Mary. They could love St. Mary banana chips. And they could be elated, that they are able to have, some level of ownership in JP Snacks through Wisynco. Or, I mean, you could just buy JP itself, but, yeah, that's how the notes to the financial statement can be useful. So largely at a glance, at surface, this has basically been Wisynco's financial statements. So I like to do now. Wisynco is definitely a company I like. So I like to put Wisynco's numbers into a Excel spreadsheet. So this is a spreadsheet that I have a compile that was basically used to track Wisynco's earnings and the overall trend in the company's profitability and all of that. So I like to assess the company's current earnings and the company's current financial performance with its historic performance, and I like to work within a 5-year spectrum. So right here I have the last 5 financial years to June 2020. So this section, the full year, and right here is the 9 months ending. I'm able to see how the company has been performing year to date relative to previous financial years. I like to track the growth rates for the company, the overall compounded annual growth rate, the 5-year average of the growth rate. Things like these are what allows me to properly assess Wisynco's performance. And when I scroll on here, I like to compute some key ratios that I find to be useful and that I find to aid in my investment decisions. Where
you're gonna need to make this one bigger, because this
I'm trying to
keep that. Yeah, I realize you're trying to keep the other side here.
How's that?
Still small. At least on my screen, it's still a bit small. So I'm assuming it will be small for everybody as well too.
Alright.
Yeah, if I make it full screen, it's okay. I can see it, but it's on a phone. It might be a bit different. Yeah.
Yeah, we can. I mean, we reviewed the financial statements already, so I've entered it into Excel right here. The line items for the company's income statement, key line items for the balance sheet, the cash flow statement, things I use to some other key line items that I like to include, and the company's key ratios and statistics. So we reviewed the financial statements already. Right here, I have the growth, the percentage movement on a period over period basis. So the ratios that investors should look out for, your profitability ratios, your liquidity ratios, your solvency ratios, like your efficiency ratios, and overall investor ratios. So your profitability ratios include your margins. So things like your net profit margin, your pre-tax margin, your operating margin, your gross profit margin, your EBITDA margin as well. These ratios suggest how profitable the company's operations are. Your return on assets as well, your return on equity as well, your liquidity position, as we mentioned earlier, to your cash ratio, your operating cash flow ratio, your current ratio, the company's free cash flow, EBITDA, the earnings before interest, taxation, depreciation, the amortization. And then we have the solvency ratios, things like your interest coverage ratio, your debt to EBITDA, your debt to equity. So we'll be focusing on this column right here, the 9 months ended March 2021. So what we see here in order, the company's net profit margin has basically been static. It moved to 9.3% from 9.2%, but when we compare it to the 5-year average that I have right here, which captures the average of the company's net profit margin, we see that on a year-to-date basis, the company's net margin is falling short of its 5-year average. The 5-year average is 10. The company's profitability is now at 9.3. We looked earlier, we know that the main reason for that is basically the shortfall in revenue. But historically, we see where the company's net margin has been as high as 11% in June 2017, and basically 11% as well in June 2016. So it's operating below capacity, but we know what's up. I find the gross profit margin and the net profit margin to be the more important margin statistics or ratios. So when we look at the gross margin, they stated earlier that it fell to 34.4%, over 34.8% for the same period in 2020. And when we compare it to the 5-year average, it's also short of a little less than 200 basis points relative to the 36.94% average over the last 5 financial years. However, the company's expense to sales, which is basically the operating expenses as a percentage of revenue, a lower ratio is generally more favorable. So this ratio has actually been a plus for them. And when we look here at the company's total operating expenses, the sum of the selling and distribution expenses as well as the administrative expenses, this declined by 11%. So the company was able to enjoy a double-digit fall in operating expenses. And as a result, the expense to sale ratio moved from 25% in 2020 to 23%. So this has been a good. We can, that's good. The shortfall in gross profit margin, it's fell by, the marginal fell, so we can probably mark that as orange. If it's bad, let's put red. I think we should put this in orange because, net profit margin has been flat, but compared to the historical performance, it's down. So we leave this in orange. The company's cash ratio, higher ratio is more favorable. The cash ratio is basically the cash the hard cash. So it's a conservative approach to the company's overall liquidity position. So it's basically cash and cash equivalent as a percentage of current liabilities, which is your short-term debt obligations. So over the last 5 years, the company's cash ratio has averaged 83%, but as at March 2021, it has more than doubled slightly. That ratio has improved to 1.64 times. We see where they've been generating cash, as we saw in the cash flow statement. So, and during these unprecedented times, you need cash as a buffer. So that we can have an understanding of why the company opted to increase its cash ratio. The operating cash flow ratio is basically the net cash generated from operating activities as a percentage of short-term debt. So it's a less conservative approach relative to the cash ratio, but likewise, higher ratio is more favorable. So Wisynco's operating cash ratio, Wisynco's operating cash ratio has averaged 0.67 times over the last 5 financial years. But as at March 2021, that improved to 8.8 times. So I'll mark that in green because that's a plus. And it also improved period over period. So basically, so far, what I'm seeing, the company is very liquid. And then the current ratio, which is the current assets as a percentage of current liabilities, the average over the last 5 years has been 2.07. Wisynco closed at 3.11 times. So the company is as liquid as ever. Free cash flow, which is basically your net cash from operating activities, net of your capex, your capital expenditure. This is a good ratio. It shows the cash available to shareholders and the company's creditors that can be used to settle, whatever debt servicing costs the company incurs, the company's ability to pay dividends, things like that. Period over period, the company's free cash flow position increased by 1.5%. So it was marginally static. But if I'm to find the average, what the average cash flow has been over the ideally I should exclude this financial year. It seems to have been an outlier or an anomaly.
2017.
Yeah. If memory serves, that would have
been the only year, by the way. It's the only year that it happened, actually.
Yeah. I assume that this is related to the fire. So
that's a possibility.
Yeah, right here we have impairment of inventory, property, plant, and equipment. So if memory serves me correctly, this would have been related to the cost that the company incurred from the fire that happened at the manufacturing facility in St. Catherine. So as a result, we see where the investing activities increased relative to the previous financial year in excess of 1 billion, and then they generated less cash from operations. So assumedly, free cash flow declined because of an increase in the company's capital expenditure relative to cash generated from operating activities. But notwithstanding, free cash flow over the last financial years over the last 5 financial years has averaged 1.2 billion. As at March, or for the year-to-date period, March 2021, free cash flow is well above that at 3.3%. The cash flow margin is basically operating activities as a percentage of revenue. So this shows how much of revenues generated actually translate into hard cold cash. And this isn't really a popular ratio, but I find it useful when I try to value companies, using like a discounted cash flow method of valuation, as it allows me to forecast the company's free cash flow over the next 5 financial years by comparing its performance to the last 5 financial years. So yeah, the EBITDA would basically be your earnings before your interest, your taxation, the depreciation, your amortization. Investors can either opt to assess the company's free cash flow, or they could be a little bit less conservative and assess the company's earnings before you have accounted for depreciation of the company's assets, amortization of whatever payments that they pay over a period of time, as well as taxes owed to the government. So the company's EBITDA actually trended downwards marginally. It moved from 3.7 billion in March 2020 to 3.6 billion for the current year-to-date period. Before I move on to the investor ratios, or your market ratios, let's look at the solvency ratios. Basically, the company's ability to cover its debt and cover its debt obligations. So your debt to EBITDA, ideally, you want this figure to be small. So Wisynco's debt to EBITDA has averaged 0.56 over the last 5 financial years. And as at the current period, it moved to 0.63 times, or 63%. So basically, debt is 63% of the company's earnings before interest, taxation, depreciation, and amortization. So overall, this has displayed over the last 5 financial years, the debt to EBITDA has displayed an overall increasing trend. They were able to kind of reverse that increase for the last financial year, when it fell to 50 times EBITDA. And then your debt to equity, which is basically your borrowings as a percentage of the capital base. Lower ratios are favorable, but this is dependent on the industry within which you operate. Because, for example, banks tend to have higher debt on their books because they use this debt to generate a higher return and achieve an overall higher net interest income, or net return on equity that exceeds the cost of capital. And then, I'm sorry, I didn't look at the return on assets. The return on assets and the return on equity, very important ratio, especially the return on equity. This shows the amount of profit that the company is able to produce from relative to its book value. So higher ratios are more preferred. Because these figures mostly represent the year-to-date period, so it doesn't really reflect full earnings relative to the company's book value. But nonetheless, you see where return on equity fell from 19.6% in 2020 to 15.9% for 2021. So I mean, this I've been color coding the results, but this is not really favorable. It's still a positive figure, so I mean, give thanks for that. But the company has been adversely impacted by the shortfall in revenues. That's one deduction that we can make with certainty. However, over the last 5 financial years, return on equity has averaged 31.9%, basically 32%. And this was mostly led by high returns on equity for the 2016 financial year and the 2017 financial year. But return on equity has basically displayed a downward trend over the last 5 financial years. It moved from 42.4% to 23.3%. Ideally, investors like to see an upward trend.
Going up.
Yeah, you like to see an upward return on the money you've invested in the company. To look at the investor or the market ratios now and statistics, the dividend payout ratio. This is basically a percentage. This is basically dividends paid as a percentage of the company's net profit. So right here, a higher ratio or a higher percentage is more preferred, because that shows that the company is paying out more of its earnings to shareholders. They're rewarding their shareholders for but money is invested in the company. Like the dividends that are paid out is, however, subject to the company's need to reinvest the company's profits back into the business and grow the business and allow the business to expand and become larger. But some businesses could be very large and just have a lot of cash on books, and they just decide to reward shareholders. So this is one of the ways that companies reward their shareholders. It's mainly done through either by ways of you reward your shareholders through dividends, you pay them dividends, or you do share buybacks. In our investment environment, companies mostly engage in dividend, paying out dividends as opposed to share buybacks. The dividend yield is the dividend per share as a percentage of the company's market price. Again, a higher percentage is more favorable. For the 2020 financial year, we see where dividend yield was 1% relative to 1.79. So, I mean, this isn't, the best thing to see.
And in the context of what we normally talk about, it should actually be added. It should actually be put against inflation. So, getting only 1% for the year when inflation is at 4%, or getting only 1% when current interest rates are extremely low at was it 0.5, right?
Policy rates are
right. Yeah, but still the inflation rate is running to 6, 4, between 4 and 6. And you're only getting 1% for the year. I mean, that's something to scoff at.
Yeah, agreed. And the dividend payout ratio for the 2020 financial year was 26.8% relative to 39.75% over the last 5 financial years. So, I mean, these two ratios are ratios that, in a more favorable scenario, you'd want these ratios to exceed the historical averages thereabout.
Yeah.
So looking at the price multiples, we see the trend in the company's PE ratio and its price to book ratios, basically upon listing. So these two cells are vacant because the company wasn't a publicly listed entity at these points in time, as at June 2016 and June 2017. It listed late 2017, early 2018. And the PE ratio that would have seen where it was trading at a PE ratio of 16 times, but it skyrocketed to 28 times. And we see this where the price doubled from $9.64 to basically $19, or almost doubled, a little bit, a couple cents or maybe $1 less, short of doubling. So at this point in time, one could say the stock moved from fair value, from being fairly valued to being overvalued. But this would basically be dependent on a comparison to key peers that operate in the same manufacturing and distribution space. Things like Seprod, entities like Seprod, or your Grace Foods division, or your Alaska manufacturers. The price fell off, or the price right here, we have where the price was basically flat. However, the PE ratio fell off. So basically, because there was a decline in PE ratio, the growth in price was not in accordance with the growth in earnings, which is actually good, because ideally you want to purchase stock your stocks at lower PEs, because that shows that they're more fairly priced or being offered at a bargain relative to a higher PE. But the PE ratio method of valuation is basically subject to the potential for earnings growth. So a further way I find a complementary ratio to the PE ratio to be the price to earnings growth ratio, which is basically your PE ratio divided by your growth in earnings.
EPS growth.
EPS growth. And ideally, a PEG ratio below 1 suggests that the stock is undervalued. a PEG ratio that is equal to 1 suggests that the stock is fairly valued, and a PEG ratio in excess of 1 suggests that the stock is overvalued. So that's, I mean, if you transpose it, basically suggests to me that PEG is equal to earnings growth. So one could assume that Wisynco's PE has grown over the last 5 financial years at a compound annual growth rate of 5.1%. However, earnings growth has averaged about 15.8 times. So 15, I mean, double-digit growth like that is great. So I mean, it's all relative, and it should be used at your discretion with respect to how you value the company using the PE ratio and the PEG ratio. So you want to basically factor in the historical growth in the company's earnings, and as mentioned earlier, the PE, the price multiples for similar listed stocks on the JSE. So the PE ratio as at the 31st of March 2021 was 21 times, and this is compared to 19 times for the same period in 2020. So because there was an increase in the company's PE ratio, this suggests that the company's earnings has somewhat fallen off, and we know this because we see where it has fallen off by net earnings fell off by 5.2%, and this PE ratio is captured using the trailing 12 months earning, meaning the earnings for the last 4 quarters.
Right.
This was $15.29 was the price as at the 21st of March. That's how I construct my Excel table. This cell right here would have been the price of $15.14 as at Friday. And that would translate into a trailing PE ratio of 20.99 times or 21 times, and a price to book ratio of 4.4 times. So let's compare the PE ratio to the current PE ratio, the current price to book ratio, to the historic average. So the historic average, which would be over the last, let's close this, over the last 3 financial years, this suggests that the company's stock is trading at a discount to the historical average of 23.6 times over the last 3 financial years. So this could probably suggest to us what would probably require more assessment, and probably would require forecasting, things like that. But at a glance, what this is suggesting us is that the company is trading at a discount to its historic price to earnings ratio. This could signal to us that now is a buy time for it, but one would be wary of any further shortfalls in the company's revenues, or if the company is unable to maintain the cost efficiencies that they've achieved and displayed here today. The price to book is also another ratio that we can use. The 3.85% reported as of March 2021 compares to, let's exclude, I don't want the null values for the 2016 and 2017 years to throw off the mean. So the price to book has averaged 5.35 times over the last 3 financial years. It's currently trading at 3.85 times. I mean, despite the downfall in revenues and the downfall in the company's net profit, the company has been generating profits nonetheless. So as a result of this, the company's book value will continue to increase, although net profit is falling off. So that's why that could be a reason why we see the net profit, the price to book, being attractive at 3.85 times compared to 5.35 times. But once again, we're in uncertain times. Revenues have been falling off. Revenues could continue to fall off. Logically speaking, revenues could continue to fall off. And then what would happen is that the company would start to report net losses, which would at that point in time start to erode the company's book value. And then that's when we would see where the price to book ratio exceeding the historic average. And this is all hypothetically speaking, not saying that I expect
It will happen.
revenue.
Yeah.
It's hypothetical. So basically, at a glance, we reviewed the financial statements, as a recommendation to investors invested in Wisynco or whatever stocks you hold. I highly recommend, having your spreadsheets and you track the company's performance, so that way you're able to assess the company's trend in its financial performance, and you compute your ratios. If you're not familiar with ratios and statistics, as I said, it basically falls under a couple broad headings: your profitability ratios, your liquidity ratios, your solvency ratios, your market ratios or investor ratios. Yeah, basically. All right, so we've assessed the financial statements and we will see the ratios and the statistics. We know what the current price is. So what I did today, I kind of wanted to compare, key profitability ratios. I find profitability ratios and market ratios to be the very, very important ratios. So what I did, I tried to compare them to key peer listed stocks on the stock exchange as best as I could. So Wisynco engages in manufacturing and distribution activities. So does GK Foods, not the entire GK group, because GK is foods and financial services. So I try to dissect GK's financial statements and find as much information as I can, so I could compare it against Wisynco and Seprod, and a combined L.E.A.R.N and L.E.A.R.D are both listed on the stock exchange. So what I did as a proxy, I combined their earnings and I combined their market cap, I combined their PBT to basically find out certain key information to see what it would be if L.E.A.R.D and L.E.A.R.N were to be listed as a one entity, as opposed to disaggregated manufacturing and distribution. So the trailing revenue, basically the revenue over the last 4 quarters, I have highlighted green that GK Foods does GK beats its peers by a landslide with respect to revenue. L.E.A.R.N and L.E.A.R.D combined with 29 billion. Separate does.
Andre, you needed to zoom in a bit, definitely.
Oh yeah, this one's small.
Yeah, that's good.
All right, good. All right, so with respect to the revenue, so yeah, I'm going to hide these cells. That's why I have it highlighted in yellow. But I used L.E.A.R.N information, L.E.A.R.D information to calculate certain key information for L.E.A.R.D and L.E.A.R.N as a combined entity. So for greater ease of viewing, let me hide it. No. So L.E.A.R.D and L.E.A.R.N collectively generate 28.7 billion in revenue. Separate does 39. Wisynco does 31, while GK Foods does 82.9 billion. So now I'll go on to compare the company's price to book, PBT margin. Sorry, their profit before tax. Profit before taxation. Basically, I did this because when I look at GK's financial statements and I dissect it to find segmental breakout of revenues, GK is basically taxed as an entire entity. So that's why right here, I'm using the profit before taxation. Most corporate entities get taxed in the same industry, get taxed at the same effective tax rate. So there should be little deviation from the PBT margin relative to the net profit margin. So with respect to profit before taxation, Seprod does the highest, but Seprod and Wisynco basically did the same in terms of profit before taxation over the last quarter. Both generated 3.2 billion in profits. After that was L.E.A.R.D and L.E.A.R.N combined, and then lastly we have GK Foods with 2.3 billion. So now from a profit before taxation standpoint, Wisynco has the greater profit before taxation margin. Wisynco generates less profits than GK Foods and Seprod, but Wisynco is able to enjoy a stronger profit before taxation margin of 10.5 relative to GK Foods 2.7% and Separat's 8.1%. So what this suggests to us is that Wisynco is very efficient. They're very efficient. They're better able, compared to its peers at this point in time, they're better able to contain their costs relative to growing their revenues. So it could be a case where they have more effective supply chain agreements, distribution channels, there are better pricing strategies. There could be a variety of reasons as to why Wisynco has the greater profit margin, but Wisynco comes in at 10.5, followed by L.E.A.R.N at 10%, and we have Separate at 8%, and then we have GK Foods at 2.7%. So looking at our market cap, meaning the current market value of the entities, we see where Wisynco is the more valued entity, but one could say Wisynco is overpriced, because when we go on further to look at the price to earnings ratio, Wisynco's price to earnings of 21 times is higher than 19 times for Separate and 16.2 times for L.E.A.R.N and L.E.A.R.N as a collective entity. So, I mean, if you want to calculate the industry average of 18.87 times is a discount compared to Wisynco's 21 times. So Wisynco is currently trading above the industry average. So that would probably suggest that, as I mentioned earlier, this is relative to the earnings potential for Wisynco, but at a glance, one could, reasonably assume that other stocks are currently at a better bargain than Wisynco currently is. But you have to bear in mind that the higher price to earnings ratio could be warranted given Wisynco's higher profit before taxation margin. It could also be warranted as a result of Wisynco's higher return on equity. The average return on equity for key peers is 16.7 times, and Wisynco's return on equity is 18 times. So that could be a reason why Wisynco warrants a higher price to earnings ratio. Again, Wisynco has a higher price to book ratio. The industry average is 3.16 times, Wisynco is 3.8 times. But because return on equity is positively correlated with book value, the higher return on equity is the greater retained earnings that you will retained earnings that you will enjoy, and you will therefore be able to enjoy rapid growth in your book value. So we normally find that a company's return on equity is positively correlated with its book value and ultimately its price to book ratio. So at a glance, we can deduce that Wisynco has the stronger profitability ratios. They have a higher profit before tax margin and they have a higher return on equity. But with respect to the market multiples, Wisynco L.E.A.R.N leads in that. Combined L.E.A.R.N with L.E.A.R.N currently leads in that department. For a point of information, or in case you were wondering, I was able to compute a PE ratio for L.E.A.R.N and L.E.A.R.N as one entity. I use the market cap, the entire market cap of the different shares for both entities, and I added it, and then I divided it by the aggregate earnings for both, and that's how I was able to find the PE ratios, and likewise the aggregate book value, and that's how I was able to find the price to book ratio. But L.E.A.R.N and L.E.A.R.N are actually not listed as a single entity. They trade separately. You have L.E.A.R.N and L.E.A.R.N. Those are the tickers right here. But just as a proxy, I wanted to compare Wisynco's distribution and manufacturing business with L.E.A.R.N, Lasco distributors, and L.E.A.R.N, Lasco manufacturers. So, in conclusion, we've assessed Wisynco's financial statements. What we've concluded is that the company is as liquid as ever. They're sitting on $6 billion in cash. They're generating cash from operating activities. They are very solvent. They're able to readily service their short-term obligations. And on the downside, revenues has fallen off, and expenses have also fallen off. But the bright side is that the company has been able to curtail its expenses. So if going forward, vaccinations increase or tourist industry increases as well, we have more stopover arrivals. If Wisynco is able to maintain the cost efficiencies they managed to achieve through the pandemic, and there's a return to normalcy with respect to the company's revenue generating abilities, and revenues increase, profits might grow at an even faster rate compared to the historic 5-year average. So that's something that we can look out for. They announced that revenue exports are up 50%, 28% year to date. So these are things that we look at as our outlook for the company, as a forecast for the company. And bearing in mind all of this, one can make the decision whether they want to buy Wisynco, they want to sell Wisynco, or they want to hold Wisynco. As Chike mentioned earlier, not financial advice, not saying you should go and buy Wisynco, saying you should sell Wisynco, just lending some assistance with respect to reviewing the statements, computing the ratios, assessing the performance, and then making an informed decision. And with that, that's a wrap.
Yeah, I have to, as I'm keenly following, and we gotta catch up on those ratios for sure, because I mean yours, man, but that's expected though. You got major skin in the game. So you're clearly ahead of me by far. And so yes,
I will say you're the resident savvy analyst in Chike.
Well, that's the thing. So I wanted to just, because we have a little bit of time. There's some questions that we're going to touch on quickly in a bit. Or I should say yes. So let me pull it up just quickly, because let's get these questions in. So I wanted to let everybody know that it might look daunting in terms of what you have to know what you're doing. That is for sure, but persons can do it. So let's deal with a couple of the questions, and then I'll pull up my sheet. I want to show them mine so that they're able to understand that this can be done by anybody if you actually have the dedication to do it. So the first question though that we have up is Hector Banks wanted you to expound on the cash flow and the cash flow ratios a bit more, if you could, in terms of it would be the importance of them.
Okay, so all right, you able to see my screen, right?
Yeah, it's come up.
So your cash flow ratios, basically, sometimes earnings can be distorted by accounting tricks and all of that. So, I mean, for example, I'm not saying that any of our locally listed companies engage in such behavior, but you want to be wary that the possibility of cooking the books and accounting tricks to report increased earnings can happen. So, I mean, you don't want to be a victim of this. So that's why you want to, in addition to earnings, you want to actually factor in the company's ability to produce cash. Because as I said earlier, cash is king. Cash is the most liquid asset, and it is what we use to conduct trade. So when you look at the cash generating ability of the company, that shows how efficiently they are to generate hard cash from their revenues and things like that. So basically, the purpose of your cash ratio is to strip out non-cash items. So as I mentioned earlier, depreciation, a company incurs depreciation charges and amortization charges, but these are normally charges that are paid out as cash. It's basically like a write-down in terms of, with respect to this depreciation, for example, assets depreciate over time, and you might buy a car for $1 million. 1 year down the line, the car is worth 900 million.
Yeah.
So that 100,000 essentially would represent, for example, that depreciation charge would fall off in the price of your asset. So again, ratios, your cash flow, your cash flows from operating activities, your free cash flow, it strips out non-cash things, depreciation, amortization, and even things like fair value movement in assets. For example, estimations. At the end of the day, it's all estimations. So you need, as an investor, you need to find out, kind of have tunnel vision, see past all the noise, and find out how exactly the company is able to generate cash from the mechanisms and the structures, the policies and the processes that they have in place. So basically, that's the importance of the cash ratios, the liquidity ratios, and free cash flow, and all of that.
Okay, so following on that question before I get to the second one, amortization. Where was that found exactly? Because I was looking for that, and I don't remember seeing it per se. I saw depreciation for sure, and that was in the cash flow, but I don't remember seeing a specific line item for amortization.
All right, 1 second. Let us backtrack. Yes, so I have depreciation amortization consolidated, because sometimes some companies report it under one. I think they only had depreciation as a line item. But historically, if memory serves me correctly, I think on the audited financials, they have both depreciation and amortization. But I think amortization is basically minuscule relative to depreciation. Okay. In order to verify, I look at the breakout of operating activities in note 32. I scroll to find 32.
You got it too far.
See, right here we have amortization.
Okay.
On a quarterly basis, they don't report amortization, but on a yearly basis, they report it. So as a matter of fact, we even see where they didn't report any amortization for 2020. So it could possibly be a new charge that they just started to incur.
And just to let everybody know where you are looking at right now, that is how you do, or that would be the figures that you'll be using to calculate your EBITDA, earnings before interest, taxes, depreciation, and amortization.
Right.
In order to get that ratio of debt to EBITDA.
Yeah.
Right. So the next question is, explain the importance of the comprehensive income on the income statement. I actually am curious about that as well, to income in relation to the regular net profit of itself versus the net income versus the comprehensive income.
All right. So the comprehensive income statement, let's look for it. To be honest, I know that where the difference between the regular profit and loss compared to the comprehensive, the regular net profit compared to the comprehensive income, is basically dependent on accounting classifications and accounting standards. So what you find is basically any gains associated with different classifications of investment securities and things like that. So on some income statements, you probably say fair value of securities through profit and loss, and then you have fair value of investment securities through other comprehensive income, or you see FV OCI. So it's mainly with relation to accounting standards and how certain assets are treated from an accounting perspective. But
you're absolutely right.
Yeah, ideally I focus on the net profit. So right here, yeah, so we see they have finance income of 320 million. We can look at note 9 to further see what kind of assets generate these incomes. Could be loans, could be corporate bonds or sovereign bonds. And then we see unrealized gains. So basically gains that have not been realized, have not been crystallized through different classifications.
Yeah. So everybody, well, actually you have to show them, but that is true. In the financial year for 2020, the full one, the total comprehensive, the other comprehensive income, that addition was actually unrealized gains of 17.3 million versus 11 million, call it 11 million in 2019. And that added to the net profit that they had, then gave the total comprehensive income. So yeah, I get that. So it makes sense in truth, because that's all unrealized. As they stated, it's unrealized gains. So it's not a true reflection of the net profit at that point. Well, I guess that's how I'm interpreting it. Not a true reflection of net profit at that point.
Very important statement, but I personally tend to focus on the profit and loss.
Okay. Oh, so yeah, this one I wanted to bring back up indeed. Well, we actually did touch it, and I did make the statement. Mikhail had asked what was finance, what explained the finance costs, or what were the finance costs. So I had actually put that inside. But if you can bring up for everybody else, if you can bring back up the sheet, not the sheet, the statements, the financial statement for their year, and go to the note. I know I didn't find finance costs notes in this one in the 9 months, but definitely in the financial year statement for 2020, it was there as in note 6, I believe it was, or note 10. I told everybody in the chat at the time.
10. All right, so
yeah,
looking at note 10,
there it is.
Yes, note 10 is basically a breakout of the debt servicing charges the company incurs on, loans and leases. So it's basically interest expense, your interest accrual, they borrow money, you have to pay it back at a certain percentage interest thereabout. So the breakout of the finance costs represents your interest expense, whether incurred on 55.6 million for the 2020 financial year on bank borrowings and leases. And then they have finance charges and non-interest fees, fees associated, any fees that could have been associated with taking out your loans, things like that. So that's basically the breakout. So basically your finance costs, most case represents your interest that you accrue on your bonds or your loans, your notes, things like that. Bank overdraft, things like that.
All right, so we have a question from the moderator themselves. How can we calculate Wisynco's PE from the financial statements?
Okay. So Wisynco from the PE, to calculate the PE from the financial statements. This one that we're on right here is the 2020 financial year. So it's the entire financial year. Because it's the entire financial year, it's 4 quarters of earnings. So the PE can be calculated. Ideally, the definition of the PE ratio is your price to earnings per share. So basically, your stock price
divided by the earnings per share for that period.
Correct. Your stock price divided by earnings per share for that period. So Wisynco has about Wisynco has this amount of shares issued and in circulation. So on a per share basis, I don't want to zoom out, but so yeah, they did net profits of 2.8 billion. This is the consolidated. So yeah, this is the consolidated net profit meaning for the group, they did 2.8 billion. All right, let's look at the continuing operations. They did 2.7 billion. That's before, the profits from this continuing operations, which could be, the straw or styrofoam. So I have it right here on my, I have the overall profit, which includes it. So to basically calculate the EPS, you divide the net profit divided by the total number of shares. In calculating that, I got, on a per share basis, I got an earnings per share of 0.71. As at the end of that financial year, as at June 30th, 2020, the price was $18.19. So at that point in time, if I want to calculate the price to earnings ratio, it would be the stock price, divided by the EPS for the 4 quarters, for the last 4 quarters at that point in time. And that gives me 26.72 times. So basically, that's how you calculate the PE ratio. If you want to, you can also basically just calculate the PE ratio without doing it on a per share basis. So the price, or basically you divide the market cap by the overall you divide the market cap by the overall net income. So this 2.8 billion, or we'll go on the Jamaica Stock Exchange website. Ideally, you want to know the market value of Wisynco as at June, the end of June 2020. So, yeah, June 2020, I'm going to pull the price as at the end of June 2020.
What do you look on, the close price or the last trading? Because I was using the close price.
No, I use the close price.
Okay, that was 1897.
Yeah, 1897. I don't think the stock exchange website allows for this market value of outstanding shares to be at a point in time. I think this is the value as at today. But essentially, if you want to find the market cap, the PE ratio, an alternative method relative to the price divided by earnings is basically just divide the entire market cap by the earnings. No, by the earnings. The 2.6 billion that they reported for June 2020, for example. But as I said, ideally you want to look at the earnings for the last 12 months. So it wouldn't be 2.6. It wouldn't be 2.8 because June 2020 has long since gone. You want to find the trailing PE ratio for the last 4 quarters. Basically, the way how I do it, I subtract on a per share basis. It would be the full year earnings per share for June 2020 minus the 9 months up to March 2020. So basically, once you subtract that, what you have left is just the June 2020 quarter, and then you add back the EPS for the most recent period. That's how you get the trailing EPS. And then I divide the stock price, the current stock price, which was $15.14 as at last week Friday, divided by the trailing EPS. And that's all I got. Sorry, this is March 2019. I need to shift that here. So it's March 2020. That's how I got 20.99 as I got it right here. So
okay.
Calculate the trailing PE ratio is a bit it's a bit more complex than just finding the PE ratio for the most recent financial year, but that's basically how I go about calculating it. And what it does, it gives me like the company's updated earnings for the most recent period that would have been posted on the stock exchange website.
Yeah. So I wanted to show everybody one important part as well too. Guesswork is not really required like that. Go to on the 2021 9 months. Go to note 3.
All right, on the 9 months, note 3.
All right, stop right there. All right, just zoom in on that. All right, so everyone can pay attention to this one as well too. This is what the earnings per share is calculated against, and it is calculated against the net profit. Pay attention to this part, everyone. Net profit attributed to the shareholders, right? If you use the regular net profit, those two things are different. The numbers might be different. Yeah. So if you use the wrong number, you're not gonna get the earnings per share that you as the shareholder are supposed to get. And you also, in terms of the net profit, in terms of the number of not the net profit, but the number of shares that is being calculated on, be very, very careful to ensure that you're looking at that part up, just highlight it for me, Andre, that says weighted average number of shares. So if a company has a total number of shares, they might normally put out that there is basic shares versus diluted. You want to make your calculations on the diluted shares all the time for a more accurate calculation. Reason being because the diluted shares is when you take into consideration the shares that might be issued to the directors, issued to the staff, etc. the addition of those shares, they can come on stream at any point in time, but they will dilute your earnings to you, the shareholder, at the end. So I have learned that you focus on the diluted shares versus the basic number, and you focus on the weighted average number of shares that is there. So this is the quicker way of finding your EPS without having to calculate your EPS. It's what it's against, basically.
Yeah, important observation. You want to look at the profit attributable to stockholders as well as the weighted average number of stock units in issue, because a company, the number of shares issued doesn't have to be fixed. It could be more. The company could issue more shares through an APO or rights issue, or it could actually be less. You know, I mentioned share buybacks earlier, where essentially the companies buy back shares and it's deleted out of history. The number of shares becomes less, which just increases your ownership stake in the company. So that's why it's important to look at the weighted average number of stock units in issue.
Yeah, very important. So well, I'm not seeing any more questions as yet. Hold on, let me see. I had written. Let me go one more. Well, I wanted to actually just throw out, just to let everyone know that it's possible to do this. Don't have to be you, right? All right. Well, actually, we do have one more. Here we go. So, what do you think? What to think when the that's a good question. What is to be thought of when the net profit on the audited report is far less than the unaudited report?
Well, what I think of when there's a big difference in the audited versus the unaudited is that maybe the management is not, I don't know, maybe they're varying accounting standards used by the management's finance team relative to auditors such as KPMG, Pricewaterhouse.
Right.
Ideally, auditors review things that you declare as revenue, things that you declare as expense, and things like that, and it's done from an external standpoint. But then one can argue that if it's done internally, if a company has great earnings, it increases, the compensation packages of management teams and directors and things like that. So one can say they have motive for cooking the books, declaring profits, declaring things like that. So you kind of want to more lean on the audited financial statements relative to the unaudited.
Unaudited.
Yeah. What if there's a disparity between them both? It would suggest that one isn't very reliable, and God forbids if it's the management team of the company you're invested in. Ideally, that probably shouldn't be a company that you're invested in, because with respect to corporate governance, you want everybody to be moral and operate in line with code of ethics.
Yeah, good stuff. So this one, I guess, is going to be for me, because I actually and shout out to Akeem, because he actually reached out to us in an email. So I'm gonna pop my screen up for this one, because you won't have this in your calculations, because he had asked about margin of safety. So I'm gonna show everybody margin of safety calculations in Wisynco. So let me share my screen. One moment, window. One moment. All right, so everybody will be seeing my screen. And I'm going to pull this up and let me make this bigger. All right. So two things are happening here. I wanted to show you guys that you can be just the same way if you have the dedication. That's the first thing. So these are my calculations of Wisynco. You saw Andre's one, and this is my balance sheet in terms of what I was looking at. As Andre said, Andre was stating all of the ratios. Now my ratios are off. I recognize that as I'm looking at Andre's one. My ratios are definitely off, and I need to do some work on it, but not off by that much. So I'm going to do a power with Andre to find out where I went But all of the ratios just the same way as you said. I look at a couple more too, because I like to look on I like to look on cash just the same, and I like to look on how the capital has been deployed. So I like to calculate the equity growth and the equity growth rate. For me, I found that Wisynco actually did a really good year in 2020, where everything, and as you notice, I'm using color codes. Everything was blue for Wisynco in the year 2020. But you're asking about the margin of safety calculation. Well, that one was easy, Akeem. And for everybody who doesn't know, I use that to try and find an undervalued company, and it's basically a Buffett calculation where you combine the price to earnings ratio with the price to book ratio, but it's a specific number that you're looking for each of them. So you are looking for a total combined number of 22.5 when you put the two ratios together. So the minimum for the price to, or actually the maximum for the price to earnings ratio has to be 15, and the maximum for the price to book ratio has to be 1.5. So as you're seeing my sheet here, you basically are seeing that I have a lot of other calculations there. So I have things like, there's the EPS, and here's the price to earnings ratio for every year for me. And then I have my price to book ratio that is here. And then Akeem asked about my margin of safety. Well, this is my margin of safety calculation based on the price to earnings combined with the price to book. Now, if I'm a stickler for what I am in terms of value investing, this is a bit high, because actually not a bit high, it is very high, because it's supposed to be at or below 22.5. But the truth is, you have to be flexible about this. And over the months, I have actually been really learning a lot more. So as Andre has focused on cash flow, and I like to focus on cash flow, there's a few things that I focused on over the months that have gone by. One of them for me that is very important is the company's free cash flow to their sales. And that was actually positive for me in my calculation this year. Or should I say, sorry, for 2020, for their 2020 year. Now, I haven't gotten to the 9 months as yet. It takes time for me to put this together. So I have up to 2020. So they've got positive free cash flow to sales. You heard Andre talking about market cap. So I like to look on their free cash flow to their market cap. This number is a bit high because it's at 32, and basically I'm looking for a threshold that is, let's see what it says, current selection. My threshold is, I'm looking for anything below or equal to 15, basically. So it's a bit high, but not in the grand scheme of things. And additionally too, you have to compare the company to its peers. So Wisynco needs to be compared to the next company that is there. One of the next companies that is actually there is separate. This is separate on the other side. But I'm still updating separate sheets, so I'm not at that yet. So we skip back to that. But we plan to actually do a session with this as well too, so that you guys can really understand. There's a whole lot you can get into, but where Wisynco is, they're clearly in their growth phase. Their sales revenue is still climbing. We've been looking at the numbers, but when you put that chart, I like my charts. Andre knows I like my my graphs. So when you put, let me find the sales one. When you find their sales, so this is their free cash flow to sales, and you see it's going back up. Where's that sales and revenue? Here we go. Sales revenue. Standard steady. This is what you want to see. Standard steady upward motion. This is showing that Wisynco is firmly growing, firmly still in their growth phase, firmly still going up. Net profit just the same way, right next to it. While it meanders, you want the general upward trend to be going up as well too. And I like to look on gross profit margin versus operating, especially operating margin. Very important for me, because I want to know how the company is handling its expenses. Now, as you notice, as I said, I like color codings. Anything that turns blue for me is positive. Anything red is a negative, and anything that is an orange, as you can see, is marginal. Orange, yellow is basically marginal. When I put all of that stuff together, just like Andre showed you, just the same way as the amateur investor I am, an amateur analyst that I am. I make then that decision as to where the company, I believe the company is at, and move forward from there. So that's margin of safety. This is my chart in terms of my analysis that I did, and it can be done if you have the dedication to do so. It's all about reading everything. By the way, let's bring it back. Everything that is on these charts, I learned from basically looking on investopedia.com or reading different books that are there. And I've shared my books before on Twitter. I'll share them again in terms of the teachings of all of these. Andre, there's something actually that I found, and we had this discussion about. It's a free cash flow. There's an indicator that in a video, in a YouTube video that was there from a long time back, from since 2011. The person taught free cash flow per share. And then they stated that when you compare free cash flow per share, which is right over here, and you compare it to the EPS, you don't want a big disparity between the two. I like what is going on with Wisynco. So this is 75 for their earnings per share versus 0.75 versus 0.59. So earnings per share in terms of the net profit, free cash flow in terms of what actual cash the company has in comparison to on a per share basis, very close. I'm actually going to add a new field that says that we'll have this as a spread. So it'll be free cash flow per share versus the EPS, earnings per share spread. And the video stated that basically when those two have a big gap, you really want to be questioning what is really going on there. I actually saw that recently as well too. And that was really when the company has the same things like the fair value gains are, for instance, if you take a look, a good example of that, I believe was Pulse, in terms of their part where they have things like the endorsements that they have, and so forth. Those kind of things there, so that are taken out, that have to be taken out of the free cash flow in that manner. You get it brings up their net profit nicely, but when you remove it, you see exactly what's going on. So yeah, guys, this is mine. In comparison to in small minuscule comparison to Andre's own. I've got work to do. But yeah, same things we're looking at though. Here's the retained earnings, dividend ratio. I always shout out to Simon about this. Simon, at my first time when I was doing this, retained earnings, I had it wrong. I had this calculation so wrong in terms of the retention ratio versus the payout ratio, because the two are supposed to add up to 100%. Yeah. And I was looking on the wrong retained earnings. I was looking on the one that is in the financial statement of itself, instead of taking the retained earnings based off of this dividend payment against the net profit and seeing what remains would be the retained earnings for the particular financial period being reported on. And I got back that 100. So I always say big up to Simon. Yeah, that was a massive input right there. Don't set me on the right path, But yeah, you're right about the dividend yield. See, I have it as well too. 1.48. I mean, we give or take, we would say that why it's COVID. But truth is 2019 was 0.76. 2018 was 0.367. 2017 was 4. Sorry, not 0.367. 3.67. And 2017 was 4. I like these high numbers because my main indicator I want to be looking at all the time is how does dividend yield stack up to inflation rate. That's the first thing I'm looking at, right? As long as my dividend yield is running above my inflation rate for the year, point to point, I'm good, right? I'm really good. And if the dividend yield is also running above the country's interest rate, and was it the 10-year, like a bond, etc., definitely even better. So yeah, yeah, that's it, guys. In terms of where we are, we'll do a deep dive. We can do a deep dive of this some other time in an hour. Actually, we have that set up as well too. I'm being pressed to do a deep dive from an amateur, analyst perspective. So that's definitely going to get done. So I don't know if we have any more questions. Do we have any more questions? So Hector's asking, I like all of this, but how do I make an investment decision? You want to take that one? You can take it, and then I'll give him from my perspective.
So I mean, yeah, one of my philosophies, I have to like what the business is doing. If you're even a customer of the business, then that's great. If you are a fan of the products and you're satisfied with the company's products, you're satisfied with the company's services, it's a brand that you'd want to associate yourself with. And then after you've done your deep dive, the company seems to be in stable financial position and is likely to operate as a going concern going forward. Then things like that's what you use to guide your investment decision. And as I mentioned, important to compare to peers. Find the most efficient, find the most profitable. This is also in alignment with your risk appetite. You know, the more risk investor would go for companies that display growth potential in the space, while the more conservative investor would probably go for the market leader that would probably be considered as the blue chip. So it also boils down to your risk appetite. Chike, I don't think I can't hear you. I think I don't know.
Sorry, I messed up. I'm on mute. Sorry about that. Yeah. So so that balloon just went up, guys. Remember, we're not financial advisors. So yeah, but the way how I make my decision is based off of that sheet that I just showed you. In terms of all of those ratios, when things are blue, that's where I'm starting to look and say I like what I'm seeing, and then as you said, Andre, I put it against the industry. So everybody, and no, you're not gonna get this. I'm gonna put that out from no. This is done by me. So this one, sorry, it's not gonna happen. But I've always put out that you guys can check the trade sheet from Mayberry. They put this out. They put this stuff out every single day, and it's a good trade sheet to use. So for me, I have a few indicators that I started calculating, and as we came onto this, for fair value, there was actually a very good article put out today. You can check it. It was put out by Jamaica National Fund Managers, and they were actually doing it against Guardian Holdings, right? But the explanation of how they did the fair value was combining the price to earnings ratio and the price to book ratio against the trailing 12 months, right? EPS. They basically multiplied the trailing 12 months EPS against both the price to earnings and the price to book. And the figures that they got from that, they took an average. And that average was the price that they started using. And then they basically used that price, did the same calculation against the industry's price to earnings, the industry's price to book, and then got a fair value calculation. So I didn't get as deep as that today in terms of what I did, but what it was, what I basically got, and I'm gonna focus again on just one part of mine. 1 second, bring it back up. Again, guys, you're not getting this, so don't even bother to ask. Here we go. So there are a bunch of calculations that I have. So just like Andre had his sheet, where it was showing the closing price, etc. I have mine. So these are actually all of the companies that are under the manufacturing sector. So that's manufacturing, as you can see, and these are the company peers to Wisynco, right? That are here, and you have Burjo, Carib Cement, Jamaica Broilers Group. Now, the thing you use, the comparison you use, Andre, of combining LASCO, LASM, and LASD is actually very important, and I need to take that into consideration. But here's Wisynco still against all of the other companies that are there. And then those companies, I basically did some calculations. So Wisynco's currently close price is currently at $15.54. Well, that was yesterday because I didn't get the sheet for today. So it's $15.54 close price. When I put together Wisynco's PE ratio and their price to book value ratio against their trailing 12 months EPS, I get an average price of $16.93, basically. So for me, as you notice, it's green again. I said I like my color codings. It means that if this particular value is greater than my close price, that's something I want to think about. But again, I'm also looking at this against all of the other companies that are there, right? But then I have other things as well that we're looking at. Sorry about that, guys. Made that a bit small. I'm also looking at things such as dividend yield. I'm looking on the earnings yield. I need to know that these things are good. So we talked about earnings for Wisynco. Here's Wisynco's earnings yield being calculated, which is 4.6%. And we didn't use GK because GK is not there. Well, GK didn't fall in the manufacturing part as Andres stated how GK gets rolled up. But the next closest person to Wisynco is Separate. And Separate is at 5.27%. Now, this particular value is against inflation of the country. So I always update whenever the point-to-point inflation comes out. I basically do an update to reflect the earnings yield of the company against inflation at that point in time, right? So yeah, and then I also have my margin of safety. There's only one company that is there, that's AMG. But I mean, just looking at margin of safety by itself doesn't tell anything. I would have to now dive into AMG. So that's how I make my analysis. Based on that is a bunch of different factors that are done, Hector. It's not just so straightforward of saying, oh, PE is this and price to book is that and so forth. No, you have to do your due diligence. As I always like to say, you do your homework and you basically pull up, you do your homework, you do your analysis to find out what the company is doing, what the company is doing against its peers, and then you make your decision accordingly. Yeah.
Yeah.
So well, I mean, Andre, as usual, tons of information, tons of it. I know this one is going to be reviewed by everyone. Those who are in it to see it, in it to find those gems, find those gains, find those good companies. Because at the end of the day, everyone, you must remember. Well, at least my philosophy is, I don't need to be in the market every single day. But I do need to know that what I choose, I can sleep comfortably enough at night. We're not traders, so we're not in the market every day. And if you're trading, that's a whole different ball game as well too. You're not necessarily looking on fundamentals. You're looking on technicals now, right? You're just looking on price, and that requires even more diligence and more time. So, I mean, do your homework. That's all I can say in that. I don't know what's your final closing statements, Andre.
Yeah, so that's basically it. You have to do your due diligence. You have to keep abreast with updates regarding the company's earnings and important news items, things like that. Just be vested in the companies for which you're investing.
Yep. Absolutely true. Absolutely true. Yeah. So we want to, again, as always, Andre, I'm looking forward to when we have our next stocks to watch, which comes up in the quarters. So the next quarter we should be having another one, you and me. We're gonna go back over how those companies are performing, and throw in some new ones that are there that have been added to the mix. But look out, guys, for our next meeting coming up as well too. That's also going to be another good one. And also, I have to zoom out. Let me see if I can zoom up properly. I'm gonna stand up a little bit. Remember, you got your merch. We got our Learn, Grow, Invest merch that we're doing now. So be sure to reach out to us to get your merch and show your display proud that you're learning, you're growing, and you're investing based off of that. And we'll definitely see you all on the next meeting. So yeah, again, Andre, thanks, and to everyone, thanks for tuning in, thanks for staying with us, and everyone have a great night.
Right, great discussion.